Apple will be reporting earnings today, November 2nd, after the market closes, which is in less than 1 hour from now, since it is 3:13 p.m. now. And so, without further ado, let's get to the data and show you how we are trading based on this data today. So, on the options time and sales tape, we can see the data here that the most significant were these 5,000 unusual options done at 12:43 at the 31-second mark. Now these are expiring December 15 at the 180 strike calls and puts. So let's take a look at the options chain for more details on what this could mean. So December 15, the 180s. We see here for the 180s on the put side, there is an open interest of 34,000, which is greater than the 5,000. So these could be closing trades. Same on the call side here as well. 35,000, which is greater than the 5,000. So because both sides are potentially closing trades, this data is not as clear as to what this trader is doing. If they were opening the trade, we believe they were selling the 180 strike puts and buying the 180 strike calls. And if you analyze this trade, this would be a long synthetic, which is a bullish long trade, as you can see here, a positive 100 delta. So the value of this trade, because it is at the 180 strike puts, this essentially means that they're willing to own 100 shares of Apple by selling those puts naked, because you can see that one of the puts is a naked put here, a -1. So each contract requires 18,000, and since there's 5,000 contracts, this trade was $90 million. Okay? So as we mentioned, there is risk involved in this trade, not only because it's earnings, but also because this could be a closing trade. And so even though we traded this, that doesn't mean that we put a lot of position sizing into this because of the data that is not so clear. The way we traded this was for the November 3rd, that expires just tomorrow, so 1 day away. We sold the 182.5 strike calls for each of our trades. We sold 2, and we bought the 177.5, one of them, and we bought the 185 strike calls, one as well, to create a ratio which is known as a butterfly trade here. Okay, so you can see here the name over here, a butterfly trade, more specifically a broken wing butterfly, costs about $157 for each trade. Okay, so this is also going long, but doesn't require as much buying power. You can see that the delta is a positive 14. And we have a slightly negative vega, which is good because we know that after earnings, the volatility will contract, it will go down. So we want a trade that can take advantage of that rather than not, right? So we want to have this type of a trade because of that. So you can see here that the potential losses, the entire debit, which is 157 over here if it drops, and has the potential to make up to a maximum of 323. So this risk to reward ratio is a 1:2, which is how we like to position our strategies if we trade. Okay, so that we are always risking something like that is greater than 1 to 2, so that we don't necessarily have to always have a high ratio of wins. We can actually have a lower ratio of wins and still be more profitable at the end of the day if we have trades that profit 200%. So that is why we trade in this way. And if you are interested in our strategies or other stocks that have more clear data where we can predict the stock price movements, then click the join button on our channel homepage to learn more on how you can join to gain access as a member to these videos that we provide nearly every day when we detect unusual options activity data that go above $1 million. Okay, so we did actually, our most recent earnings trade was AMD, also was also correct actually, and we will actually, if we have time today, we'll go over that trade. I know a lot of our subscribers are asking us to go over that trade. That was a winning trade, profitable, but we haven't had time to go over that. And also the trade actually expires tomorrow, the options tomorrow. So it would probably be good to go over that tomorrow once they are nearly expiring to see the result of that trade. But we used the same strategy, a butterfly trade. Except in that case, we hedge to the downside. For Apple, we are not hedging, but we are using our position sizing as a way to hedge. Okay, so we know exactly how many contracts we want to put on here, and we know our max loss is 157, so we use that as our hedge there by deciding how many do we want here as a way to hedge. It's using our position sizing. And so that's another way of how we can hedge when the amount isn't so much, 157, not so much. So we can just use this as a hedge and decide how much we want to risk for a trade that is only just one day. And so again, earnings trades, always very risky. So keep that in mind if you are trading earnings. And again, smash that like button, subscribe if you haven't, and hit the bell icon and you will be notified of unusual options activity. Take care and good luck with Apple.